Good afternoon.
Good evening.
Good evening.
Yes, how are you?
I'm okay. How are you?
I am fine. So you missed yesterday's session, right?
Yes, I did not have the link.
Okay, good. That's good. Okay,
Okay.
so we're starting with chapter 8 tonight to the end.
Okay, chapter 8.
Retirement and removal of trustees.
Okay.
So this is how we did it last night. Do you have any issues with that chapter? It's rather short.
Which chapters did you guys cover? Did you go from 1 up to 7?
Yeah.
Okay. So far, so good, I think. I
Chapter
haven't,
8.
I haven't read all of the chapters. I'm still trying to catch up.
Okay. Okay.
Yeah.
All right. Pickstock, any issues with chapter 8?
No, Mom.
Okay. So the next chapter is the heavy chapter, which is the role and responsibilities of the trust administrator. You have any questions there?
We can go over chapter 9.
Okay, all right. So chapter 9 speaks about the role and responsibilities of the trust administrator. And really the role of the trust administrator is to assist the trustees. So they have a very important function that they carry out. And you'll find over time that when you start in the trust business, this is one of the first roles. Remember, I said yesterday, you start out by being a junior administrator, and then you become an administrator, senior administrator, and then after that, a supervisor. So the trust administrator carries out all of the responsibilities, remember, that is already given to the trustees, but they carry out the duties for the administration of the trust. So they're the ones that does all of the legwork. They oversee the trust on behalf of the trustees. So when you have a discretionary trust, the trustee cannot delegate that power, that discretionary power. He can't delegate that. But he could delegate specific tasks to the administrator. And he can also employ agents to assist him in carrying out his functions, which is to hold, to manage, and administer the trust property or the corpus of the trust. So whatever the trustee does, when he's delegating his discretion, he has to do it within the provisions of the trust deed and the trust law. So remember yesterday I said that when a person wants to establish and express trust, irregardless of the type of trust it is, once he enters into that professional bank or the bank and trust or trust company, those persons in the company who would sit around the table as representing the trustee, which is the actual entity, is the trustee, the trust committee. Those are the persons who are going to deliberate and make decisions as to who will receive income and who will receive capital from the trust. They are also responsible for making sure that those decisions are documented in the minutes. So the trust administrator, who is going to assist the trustees in terms of you exercising their discretion when the trust committee meets, have to be highly trained and skilled. They have to be knowledgeable of the terms of the trust. So for each trust that you are responsible for, you have to know what the trust is about, what the assets of the trust are, any agents who have been employed to assist with that trust. And you also have to know the parties to the trust. So that means that if one of the trustees is outside of that trust company, you have to know that trustee, who that trustee is, if they're licensed, are their license still current? Then you also have to know the beneficiaries, who they are, where they reside, what is the tax regulations in that jurisdiction, what the beneficiary does for a living. All of those things you have to know. So when the trust committee meets, it relies on the information that's provided by the trust administrator, because the information that the trust administrator provides is what they're going to use to deliberate and make decisions. So the trust administrator, again, have to be highly skilled and trained. They have to be knowledgeable about the trust and the parties to the trust. And then they also must understand and be knowledgeable of the trust laws. So you can see that this is the first part of this whole journey in learning about trust to be a trust administrator. So that's why I said yesterday, when you look at the first chapter, all of the laws that are listed there, they govern trust business. And you have to get familiar with the legislation. So the standard and duty of care that's expected of trust administrators is a very high one, because it is a very professional job. And the professional job requires, because the company is licensed by a regulator to carry out trust business, then it is expected that the persons who carry out the function within the trust company are highly skilled and they are professional. It is also expected that the person that they employ to assist with the management and administration of those trusts are also highly skilled. And the legislation speaks to what the trust company must do when they employ agents. So the trust administrator is encouraged to review the trust instrument, any documents, so that they familiarize themselves with the beneficiaries. They have to look at what the beneficiary are entitled to. They look in the trustee to see the trustee's duties, what their powers are, who are the agents, who are the trustee, what are the trustee investments, and look at the terms that govern the trust. So that means that they look at the strategy, they look at the objectives of the trust. If there is a letter of wishes, they would look at the letter of wishes also, even though it is just there for guidance and it's not legally binding on the trustee. So besides that knowledge, a trust administrator must have certain skills. And one of the most important skills they must have is organization skills. You have to be efficient to be an administrator, because you have to diarize recurring and important events. You have to prepare trust files, and you have to be able to use whatever is the software, the database, in order to input and store information. So that's one of the skills. If you're not a person who likes to organize things, then you're going to have difficulty in this role as a trust administrator. You're also going to have some knowledge of legal and tax opinion, changes in trust legislation, amendments to the trust, and changes to the beneficiary's circumstances. So that means that you have to keep abreast of the tax law in the jurisdiction where the beneficiaries live. You're going to also have to look at whenever there are amendments to the trust law in the Bahamas, because the trust will be governed by the laws of the Bahamas. And then, of course, you have to look at whether any of the circumstances of the beneficiaries have changed. So you're looking at whether or not the beneficiaries had children, whether those children, if they are in school, whether they're in the same jurisdiction or not. So all of those things the trust administrator has to be aware of, because they have to provide professional assistance and support to the trustee. So the trustee is not going to sit at the committee meeting and then decide to figure out how many beneficiaries is under this trust and how old are they now and who's entitled now. Did anybody move? The trust administrator, their function is to put all of that together in the report.
Sorry, Ms. Archer, you said that the point that you made, you said that the trustee needs to know if anything has changed, you mentioned?
Mhm.
Okay,
Change in terms of the beneficiary's circumstances, where they live, whether they're still married, got a divorce, whether the children still residing at the same school. Because remember, everything is based on the trust deed itself. The trust deed could have stipulated that children of the beneficiaries are to be paid X sums of money or are to be paid for their tuition as long as they are schooled in this jurisdiction. It depends on how the trust is worded,
okay,
right? So that's what I mean by circumstances. Now, the circumstances is different from the investment. Because remember, when the settlor transfers those assets to the trustee then he holds and manages those and administers those on behalf of the beneficiary. So then his duty and his powers are around those assets, because the beneficiaries are waiting to receive either their income or capital from those assets in accordance with the terms of the trust. So the trust administrator, when he is carrying out his administrative tasks and his responsibilities, he has to do it within the context of the trustee. Because remember, it is the trustee who has been given the power, not the trust administrator. So he has to make sure, the trustee has to make sure that when he reads the trust deed, he understands the extent of the powers of the trustee, and he has to operate within that power. Another task of the administrator is he has to review and analyze all of the bank and investment statements. If he reads the statement and he sees there are queries, that is the responsibility of the trust administrator to reach out to the bank or the investment advisor or the investment manager for clarification. You'll see later down that that is critical for the trustee committee. Why? Because the beneficiaries can sue. He may also have to inspect trust property to make sure that it's still being managed properly, that is being preserved, protected, because what you don't want is for a beneficiary to raise question about one of the assets of the trust that is deteriorating and the trustee has not put in measures to preserve it. Because remember, one of the duties of the trustee is to preserve and protect the assets of the trust. So one of the main requirements of the trust administrator is he has to keep beneficiaries fully informed of the trust and also keep the beneficiaries informed if there are any changes to the trust. and whether or not any decisions of the trustees may affect their entitlement or not. And you have to do this on a timely basis. Because remember, the beneficiaries have a right to information, not a right to all information, but a right to certain information. So the trust administrator has to make sure that their another skill that they have besides good organizational skills is they have to be good at time management. The trust administrator has to make sure that when the trustee exercises his discretion, he exercises it in a timely manner in accordance with the terms of the trust. So if the terms of the trust says quarterly distribution, then he has to make sure that he does it quarterly. So that means, again, it's a part of scheduling. Any inaction or omission on the part of the trustee in exercising his discretion, if it is mandated in the trust instrument, can result in the beneficiary suing for breach of trust. So it exposes the trustee to a liability. Now, like I said, the trust administrator has that responsibility to make sure that the investments are being managed properly, that the agents that are being employed by the trustee are carrying out their duties in order to comply with the provision in the trust deed. But in the trust deed also, it may have provision where consent is required. The consent could be from the beneficiaries. The consent can be from the protector. It may also have a provision in the trust deed where notices have to be given to the beneficiaries. And so the job of the administrator is to make sure those things are done prior to the trustee exercising his discretion. And all of this is done so the trustee avoids being liable. And when I say avoid being liable, he avoids being sued by the beneficiaries for breach of trust. Because he may have exercised his discretion beyond his power. And if he does so, then the question arises as to whether or not the transaction was valid or not. So a trustee, remember, has that duty to manage and hold and administer that trust property. And with that duty, he has that duty to account. So by law, he has to keep financial records and accounting of the trust property. Because the beneficiaries at any time can come to the trust company and ask the trust administrator to see the accounting of the trust. So hand in hand, on the trustee side, he has a duty to account, and on the beneficiary side, he has a right to information, but he cannot see the information regarding the deliberations of the trust committee. What you don't want is one beneficiary fighting another beneficiary. So that information is not shown to a beneficiary. So when you read the Trustee Act, Section 83 speaks to the beneficiary's right to information. And in that section of the Act, it says that a beneficiary can inspect trust deeds, accounts, and other trust documents, but not the minutes. The trust administrator has to make sure that the documents are properly presented when they are requested and they are organized in the appropriate trust files. So you make sure that everything is always in order, because if the beneficiary then says that they're going to bring an action, they do not understand the accounts, they don't know what is going on, at least your files are in order to present them to the court. Now, in the event the amendments have to be made to the trust instrument itself, the administrator again has that function to make sure that the amendments are done in accordance with the powers that are being reserved within that trust instrument. If you're amending a trust instrument, that amendment has to be clear and unequivocal. It cannot be ambiguous. Because what you want to avoid is any challenges to the amendments that you made to the trust. Those amendments could be change in beneficial entitlement. It could be change in consent, change in notices. So the trust administrator not only protects and preserves the trust property based on the amendments that they make, but they also have to ensure that the legal protection and the remuneration of the trustees are not adversely affected. Remember, as a trustee, the two key things is I'm being paid, and the second thing is I don't want to be sued. Now, he also have to make sure as the trustee that the amendments don't go against the existing laws. All the laws that are at the end of that first chapter. He has to make sure that whatever amendment he makes are within the laws of the Bahamas. If the amendments are going to create additional responsibilities for the trustee, then that means that remuneration has to change. So he has to be very careful when he's making amendments, that he's not adding on more duties or giving himself more powers, expanding his work, and he hasn't adjusted the remuneration. Because if the remuneration needs to increase and that has not been addressed, then he may have to go to the court to ask the court to be paid for the services that he's providing. He also doesn't want to increase the risk exposure. Because if you increase the risk exposure, looking at the total risk of all the portfolio, he may have to increase his insurance coverage. So a trustee himself has to look at just not him and his performance in carrying out his duty. He also has to look at risk, and he has to also look at what protection does he have when he's carrying out his functions. So overall, he has to make sure that he carries out all of his functions. And he has to make sure he does it efficiently with the support of the administrator. Any comments or questions?
No, ma'am.
All right. 10. General principles of trust accounting. Any questions there?
Yes, can we go over this chapter as well, please?
Yeah. All right. So I just mentioned to you that the trust administrator assists the trustee in terms of diarizing recurring events, making sure based on their duty to account and the beneficiary's right to information that they have proper financial records. So that duty to account that a trustee has, it's a general duty. And they have to make sure that when they are actually managing and administering the assets of the trust, they have to determine who are the income beneficiaries and who are the capital beneficiaries. So, you know, income means the amount of monies that you make from the capital investment. The income beneficiaries goes to what we call the life tenants. The capital beneficiaries is always goes to the remainder man, means whoever's going to be left at the end. So capital can be accumulated, income is generated, and the trust is being administered to manage both of those elements. So for a trust account, it has a capital statement and an income statement. And what you will see on the both sides are increases and decreases for a specific period. And that period depends on the accounting year of that trust. It could coincide with the anniversary date in which the trust was originally created. Or it could be set for when beneficiaries have to file their taxes. But whatever date that they choose, that date is fixed. Unless the trust instrument permits them to change it. So under the Trustee Act, it states that a trustee of an express trust must maintain reliable accounting records in relation to all sums received and expended in relation to the administration of the trust. So he has to keep receipts, whether for sales or purchases or any other transactions. All of his expenditure, he has to keep receipts. He has to keep documents on the assets and liabilities of the trust. So he has to, in his records, he has to be able to correctly explain all the transaction, enable the financial position of the trust to be determined with reasonable accuracy at any time. He must allow financial statements to be prepared. And for all of his transactions, they must have invoices, contracts, and receipts. So in law, they say that he must have reliable accounting records. Remember, beneficiaries have a right to information. And that right to information when they come to the trust company is to see the accounting records. So accounts, trust records by law must be kept for a minimum period of 5 years for an express trust. Failure to do so results in a fine. So now let's look at trust income, which relates to the life tenant. And just how it says life tenant, it means during the lifetime of that beneficiary. So income of the trust fund can come from different sources. It comes from the interest made on deposits, from dividends, from shares, stocks. It could come from rental income from properties, or it could come from loans. So if you look at it from an accounting perspective, this is a pool of money coming in from different sources. That's gross income. If there is a capital gain on a particular investment, they are not classified as income for the purposes of the trust, and they are therefore not distributed to income beneficiaries. Capital gains go to capital unless the trust instrument says otherwise. So when it comes to considering income for the trust property, there's some things that the trustee have to take into consideration. One, he has to look at his power to accumulate or retain income. So the trust instrument tells him whether or not he could pay out all of the income he receives for that period, or whether or not he has to accumulate that income for a particular purpose or time. He also has to consider, when it comes to trust income, before he pays the life tenant, he has to think about to which extent income may be paid or used for the benefit of special beneficiaries. And remember, a special beneficiary is a beneficiary who is either physically or mentally challenged. Before he pays out income, again, he has to think about the beneficial interest, which may be entitled to income. So again, the trust administrator will provide him with the information as to who is entitled to income from the beneficiaries. Then he has to do the proper accounting of gross income to the extent to which this income may be distributed to the relevant beneficiaries. So these 4 points he has to take into consideration: whether or not he needs to accumulate, whether or not he needs to pay benefits to some special beneficiaries, whether or not he needs to retain some income, and then he has to look at who is entitled at this point in time to receive income from the trust income. So he's taken all those things into consideration. Then he has to deduct his expenses, because the expenses have to come out before he distributes. So expenses under income are what we call recurrent expenses. And those are payable from the income, trust income, subject again to what the trust instrument says. Because this trust instrument can actually list certain expenses that should not be deducted from trust income, but rather deducted from trust capital. So the normal reoccurring expenses are expenses related to the administration of the trust, expenses that relate to the protection and preservation of trust property, expenses related to the investment management, or expenses related to the income generation, or just expenses just for the management of the trust. Again, the trust instrument will tell you which expenses, according to the agreement set out in the trust instrument, should come from income or capital. So payment of expenses can be made from either one, income or capital. So inherent in the power to make payments from income or capital, there is a discretion, and the trustees have to decide which account expenses will be charged or paid. Again, they can accumulate or they can retain income that is not being paid out. And the trust instrument will direct whether or not you're accumulating or you're paying out. So if the trustee decides that he is not going to be paying out any money, means that he's going to accumulate, that has to be documented in the trustee minutes. And in order for him to do that, that power to accumulate is written in the trust instrument. If it is not written within the trust instrument, and the trustee feels that it is in his best judgment to accumulate in order to meet the demands of the capital beneficiary, then he rely on the provision within the Trustee Act. Now, his power to accumulate cannot be excessive. So that means that he cannot, on every period, so he's accumulating, and not pay any money to the income beneficiaries. So in order to accumulate, he must have that specific power. So the net income of the trust is calculated at the end of the trust accounting period. And that's the figure that he will use in order to distribute to the beneficiaries. Now, when it comes to capital, so capital is where you're looking at the assets itself, the corpus. They could be distributed to beneficiaries in a fixed interest trust. Or if it's a discretionary trust, if the trustee is exercising his discretion, he can pay capital. But is normally paid to beneficiaries entitled after the expenses for capital have been paid. The same way under income, the life tenants are paid after the expenses. So for capital, and remember now, when we talk about capital, you're talking about the capital assets. You're talking about the investments itself. Expenses could be for the protection and preservation of the capital in the trust. It could be principal on mortgages for the trust property. It could be improvements, substantial improvements that are being made to properties that are part of the corpus of the trust. Professional brokerage fees and other stock transactions, equity transaction, those can also be deducted from capital. So normally what the trustees will do to protect the interests of the beneficiaries, they will take into consideration the time in which the beneficiaries will obtain the capital and the amount to be distributed. So you can see that trustees have a very challenging job because they have to pay the income beneficiaries as stipulated within the trust deed, but they also have the capital beneficiaries. And they have to protect the capital for those beneficiaries. So when it comes to capital, the trustee then have to take into consideration advancement or appropriation. Advancement is where a trustee would give a large sum from the capital to make some long-term or lasting provision for a beneficiary. So let's just say in the trust deed, at the time the trust deed was drafted, the settlor had said that I have 3 children. When they attain the age of 18, but not later than 21 or 25, they are to be given the sum of $100,000 to begin their business based on their career. That will come from capital. It has to be for benefit of that beneficiary. It cannot be for the benefit of the beneficiary's spouse or the beneficiary's children. The trustees actually stipulate the purpose for that capital advancement. So the trustee can't benefit from the advancement, nor can anybody else. The key word to advancement is that word benefit. So they have to ensure that it is for the benefit of the beneficiary. Even though there may not be no real need for it, it has to be for the benefit of the beneficiary. Now, under capital, he can also do an advancement. An advancement could be where the beneficiary wants to create a new trust. So as long as that beneficiary is sui juris, an outright payment can be made to that instrument, made to that beneficiary, as long as the trust instrument states that it can be done. And so a new trust can be created. And existing trustees can manage and administer the assets of that trust. So appropriation is the trustee's action in apportioning a part of the trust for a particular purpose. So when a trustee apportion a part of the capital, the beneficiaries of that amount that has been apportioned have rights only in that amount. They don't have any rights for the funds that are left. So a portion can be done in the trust instrument itself. It could be a specific provision that speaks to apportionment. And in order to exercise or carry out apportionment, you must have the consent of the beneficiaries. But you don't need it if the trust instrument says that you can apportion. And also, if the beneficiaries are aggrieved, they can go to the court. So apportionment is really a process. And where the trustee will use a specific asset in the trust fund to meet full or part of a beneficiary's entitlement. So let's just say the beneficiary says, I'm a capital income. I'm entitled to capital income. I'm one of the remainder man in this trust. And based upon the trust instrument, at the end, I am to be entitled to $200,000. I want my $200,000 apportioned. If the trust instrument allows it, that $200,000 can be apportioned. That apportionment means that you're not entitled to anything else that's in capital. Your funds have already been taken out.
So, Ms. Archer, sorry. So if the trust instrument doesn't allow it, can they go to the court to see if the court would grant it?
Yes.
Okay. All right.
Most of the times when provisions are not made, they go to the court. The avenue is always there to go to the court.
Okay. And that would be based on the discretion of the court, whether or not they want to allow it.
Yes, they will exercise. They don't exercise their discretion, they exercise their power.
Okay.
Yeah.
Okay.
Okay, Unit 11. Unit 11 is on investments.
Okay.
Any questions there?
I started unit 11, but I didn't get a chance to finish it as yet. So we can go through it. I don't know if Arian, you got to unit 11 as yet?
No, I haven't started that as yet.
Okay, so we could go over unit 11.
Okay. So Unit 11 is about trust investments. Good evening, Theodore. Yeah, his thing is still muted. Okay, so you could see, starting from the previous units, that the trustee's main duty is to protect and preserve the assets of the trust. And to protect and preserve the assets of the trust fall within his duty to hold and manage and administer those trust assets. To do that, he has to invest because he has life tenants and he has remainder man. And in the back of all of their pockets, they have that right to sue. So the trustee is exposed to liabilities. And so he has to reduce his risk. And to reduce his risk, he is going to employ agents to assist him. And when he employs agents, the agents have to meet the criteria that's set out in the Trustee Act. So when you look at the trustee's duty to invest, he goes to the powers that are within the trust instrument. I don't know if you received the email from Ms. Dean, because I would have sent the class earlier 2 examples of a trust deed. One is a purpose trust and the other one is an asset protection trust. I sent out
No,
I
I
didn't,
only got
yeah, I
the,
didn't get it.
I only got the link for the class tonight.
Okay,
Yeah.
I sent her a
So-
reminder.
Mhm.
Let me. I've sent it to her again. Make sure she sends it, because I reminded her last night to make sure she. Theodore, you have it though, right? I think Theodore has it. But he is not talking. If you want to,
Oh,
text-
I have it. I have it. I see that Miguel sent it at a short time ago, a short while ago.
okay, all right.
Okay, let me
Right.
check my email. Yeah, I don't have it.
Okay, send it to her, please.
Ariana.
Let me know when you have it. And then I want you to open up the one that says Asset Protection Trust.
Ariana.
Sorry, my email address. Let me give it to you. Let me go back. Okay, so it's ARY notes at yahoo.com. ARY notes at yahoo.com. Okay.
Okay, I just sent it.
You sent it?
Okay.
Okay.
That's it. Open to the
Okay.
Asset Protection Trust.
Hi, good night all. Sorry for joining late. Was this sent before, or was this something recent Ms. Dean she would have provided?
No, you would have gotten it when I sent it to the class earlier.
Okay, all right,
Remember trustees?
right. The one with Robert was sending to us, I think.
Yeah, yes, that
Okay,
pull up the Asset Protection Trust. And for what you missed yesterday,
I'm gonna miss the right thing. This the thing with the deed of retirement.
that's one of it. That's one of the documents.
Okay.
And then you should have an Asset Protection Trust and a Purpose Trustee.
I see
I have
trust,
the asset protection trust deed, and then I
trust
think we had to
judgment.
access the next one through our emails because it wouldn't open on our phone.
Oh, okay. Well, send her the Asset Protection Trust then, since she can't get that one open.
Yeah, I see trust judgment and trust admin Belgravia.
I share what your email is.
a.pickstock@hotmail.
Ariana, what your email is? Your email address is.
It's ARY
Mm-hmm.
notes at yahoo.com.
Now, you need to open up two documents. The Asset Protection Trust, and I want you to open up the Trustee Act. I won't give you much headache, but this is gonna have to be how you will study it. when you go to study.
I just sent it because of the file size. It may take some time to come through.
Okay. Give them a couple minutes. So page I'm gonna start with. That's the same reason why I don't send them, because even when I send them one, the files are so big. And then when you send the link, sometimes you can't get it open. Okay, so while we wait for that, let's
I
go
got
to
it.
the audit. Okay,
Yes, ma'am.
I just want to point out certain provisions in the trust deed under the Asset Protection Trust. If you go to clause 17A, it speaks to accounting. And we just did accounting. It says the trustee shall at all times prepare and maintain proper accounts of the affairs of the trust fund. The financial statements of the trust fund shall be prepared on a calendar year basis. At the request of the protector, at any time or times, the trustee shall do all things necessary or advisable to pass such accounts before a judge or official of the court of competent jurisdiction, and to provide the protector such information as the protector may request regarding such passing of accounts. So you see this provision is already in here. This one doesn't go into in terms of which expenses are to be deducted, but that can be done. Then under 17B, it has a spendthrift provision. No beneficiary hereunder shall have any right, power, or authority to sell, assign, pledge, mortgage, or in any other manner to encumber, alienate, anticipate, or impair all or any part of his interest in the trust fund. So you can't go around as a beneficiary making a pledge saying you're going to sell, saying that you have the power to sell, because remember, the assets in the trust belong to the trustee because he has the legal interest in the assets. Then it says, going more to the end, it says, no creditor of any beneficiary shall be entitled to obtain an order for attachment of the trust fund, either by way of execution in bankruptcy proceedings or otherwise. Again, because the assets of the trust do not belong to the beneficiary. Notice it has a provision for sovereign risk. So now let's go to provision 19. When you look at the provision 19 in the trust instrument, I want you to look in the Trustee Act at part, go slow, at part 2. Part 2 is sections 4 through 13 of the Act. That whole part 2 deals with investments. So remember, the first instrument you're going to look at is the trust instrument itself. Then you go to the trust deed if things are missing. So start Unit 11. Trustees have a duty to invest. And at the center of investing, they have to protect and preserve the trust assets. They have to make sure they don't incur any losses. They have to make sure they try to maximize the most returns on those investments because they have to meet the needs of the income and the capital beneficiaries. So under common law, which is case law, trustees have an expected standard of care in respect of their duties. Because remember, I said that an administrator who assists the trustees have to have certain skills and aptitude to carry out their function. So for a trustee as a professional, they are at a higher standard. And that standard of that duty was set out in the case of Spite versus Gaunt. And it says he has to take such care as an ordinary prudent man would take if he was under a duty to make investments. So I give you the quote in the chapter what Lord Watson stated. He said, as a general rule, the law requires of a trustee no higher degree of diligence in the execution of his office than a man of ordinary prudence would exercise in the management of his own private affairs. So you can see that whenever a beneficiary challenges a trustee with regard to investments, the court would look at the actions that were taken by the trustee. Is it one that a prudent man would do if he was investing his own money? Yet he is not allowed the same discretion in investing the monies of the trust as if he were a person sui juris dealing with his own estate. Businessmen of prudence may, and frequently do, select investments which are more or less of a speculative character. But it is the duty of the trustee to confine himself to the class of investments that are permitted by the trust. And he is to avoid all investments of the class which are attended with hazard. And that is broken down even further. Because what the common law cases are saying, inclusive of Cowan versus Scargill, is that the trustee has to ensure that when he is investing, that he makes sure that the assets are being invested for the benefit for the persons for whom he has been entrusted with those assets for. He has to be morally bound to provide for those beneficiaries. So he's not acting just in the best interest of the beneficiaries and for their benefit, present and future. But he also has to make sure that he has provision for their financial benefits. So he has to make sure that he has the financial returns in order to meet his obligation to pay from trust income and capital income. So it says in Cowan versus Scargill that trustees have strongly held social and political views. They may be opposed to an investment in South Africa or any other country. They may even object to other forms of companies like tobacco company. They may personally say, I don't want to invest in tobacco. I don't want to invest in alcohol. I don't invest in anything that's going to damage the body. The judge says in the conduct of their own affairs, of course, they are free to make any decisions they want about investments. But under a trust, if investment of this type would be beneficial to the beneficiaries than any other investment, the trustees have to refrain from making the investments by reasons of the views that they hold. That's what the case of Cowan versus Scargill decided. The trustee cannot take his personal opinions and use those as judgment for investments. He has to look at what is beneficial to the beneficiaries. Otherwise, he's going to be sued. So when he is in doubt, he should seek the advice of the courts. So when you look at investments, in terms of what governs a trustee carrying out his duty to invest, there are two routes. One, we have the common law approach, and then you have statute, and then you have the provision that's in the trust instrument. So under common law, it says trustees are expected and required to act as a prudent man of business. That's Spite versus Gaunt with regard to the investment of trust property. To supplement that standard of care, trustees must perform certain established duties in relation to the investment of the trust funds. They have to make sure you don't invest it in anything that's risky or hazardous, unless the trust instrument says you can do so. He must have full information on that investment, which means he must carry out due diligence on that investment. So let's just say it's a mine that they're going to get some minerals from, and he wants to invest in that. He has to do all of the background check to make sure that that is going to be one of the best financial benefits for the beneficiaries. He also, as a part of his duty, owes a higher standard of care, especially if he's working for a trust company. The trustee should also undergo periodic reviews of the investments that are held in the trust. You cannot just take the assets, invest them in company A shares, and forget about it. It has to be constantly reviewed, whether you're doing it quarterly, whether you're doing it semi-annually or annually, based upon the type of investment. And where the purpose of the trust is to provide financial assistance of the beneficiaries' best interest is always, like it said in Cowan versus Scargill, the best financial interest. You cannot take into consideration your moral beliefs. Now, that's common law. And common law, you know, is based on case law. And the cases are in your book, and you can find summaries of those on the internet. Now, that's common law. In the Trustee Act, in those sections that I referred to, 4 through 13, what the Bahamas has done is taken those common law provisions, and they are in law. So Section 4 gives the trustees the full powers to invest. Section 5 gives the trustees guidance on the exercise of that power, whether you want to make or change or retain any investments. And it also narrows that standard of care of a prudent man set out in Spite versus Gaunt. So according to our act, it says trustees should consider the following when they're making investments. They have to exercise reasonable care, caution, and skill that an ordinary man would. They have to have regard of the suitability of the trust investments. And when you look at the suitability, it's not the suitability of just one investment. You have to look at the suitability in the context of the trust as a whole. You have to balance out the risk and the return for those assets. Remember, You have income, the life tenant, and you have capital, the remainder man. And you also, when you look at investment, is you have to diversify. So subsection 2 of section 5 gives you the consideration that the trustee must have in relation to deciding whether certain investments are appropriate for a particular trust. So he looks at the size of the trust property. He looks at the general economic conditions, where the investments are. He looks at the intentions and the wishes of the settlor. Under section 6, the trustee is not only empowered to select certain persons to provide investment advice and expertise, but they also must have the requisite knowledge, experience, and skill so that he is protected in the event there's any loss is suffered by the trust. Section 13 allows protection of the law for any liability or loss. And if the settlor himself has a settlor directed trust, then the settlor takes on that liability in the event that the investment doesn't yield the profit that he's looking for. So for a trustee, he can only be afforded a legal protection if he has properly discharged his obligation. And his obligation with regard to investment and making sure that he selects and appoints the right person to give him advice, and that he continuously supervises his advisors. Otherwise, the beneficiaries are going to sue. And he must do all this in the course of supervising the trust itself and protecting and preserving the trust assets. So if he properly appoints his agents and he supervises his agents, then he has reduced his liability and he has some protection in the event that there is any loss due to the actions of these agents. He also has to make sure that he has a proper investment objective and he has a strategy to invest trust property for that trust. And that's done through the trustee committee based on the information that the trust committee receives from the trust administrator. Once that investment strategy has been created, the trustee has to ensure that there are periodic reviews of the investments and the strategy to make sure that no changes are necessary. Because what he's trying to do is to avoid any loss. So the trust administrator here has a role. Like we said in the earlier chapter, he has to review and inspect the brokerage statements on a regular basis. He has to provide the trust committee with information regarding those investments. He has to look at terms of the trust instrument and the powers that are given within that trust instrument. He has to look at the information related to the beneficiaries and the circumstances of those beneficiaries, whether they've moved, whether there are changes in their lives, whether they had children, look tax changes. He has to also be knowledgeable and informed about any advice or recommendation that has been given by the investment advisor. So you can see that the bulk of the trustee's work is his duty to invest. And that duty to invest and that duty to account is highly important because the beneficiaries have a right to sue. So in that asset protection trust under section 19, it gives you a general investment power. It says any monies requiring investment hereunder may be invested in or upon any such investments of whatsoever nature and wheresoever situate, and whether producing income or not, including the purchase of any immovable or movable property whatsoever, or any interest therein, as the trustee shall in its discretion think fit, without being limited by any specific powers expressed herein. So notice in this asset protection trust, there aren't much stipulations. But in section 21, it says there is no duty to balance or diversify investments. The trustee should not be bound to maintain a balance between income and capital, nor shall it be under any obligation to diversify the investments in the trust fund. So you see in this trust, the settler has already set out that the trustee has not to go through all of that balancing act. And he's under no obligation to try to diversify the investments. In 22, the trustee has no duty to oversee companies. But in 23, he says the trustee has the power to retain the family property. So whatever those assets are, the settler is telling you he wants those assets to remain within the trust. 24, he says the trustee has the power to permit persons to use and enjoy the property. And he says here, the trustee may permit any person to occupy or reside in, or upon, or have the use and enjoyment of any movable or immovable property for the time being held upon the trust for such periods and upon such terms and conditions as the trustee in his discretion thinks fit. And of course, he can get any rent. He can forego any conditions of rent and rates, expenses and outgoings, insurance, repairs. Then remember, we spoke about the power of appropriation. And in this trust deed, the trustee, in his discretion, can appropriate a part of the trust fund. 27 gives the trustee the power to value the trust fund. And 28 gives the trustee the power to determine whether monies are capital or income. It says the trustee may determine, as the trustee shall in his discretion think fit, that the law may permit whether any monies for the purposes of this trust be considered as capital or income, and whether out of the capital or income, any taxes, expenses, outgoing, or losses shall or ought to be paid or borne. But unless the trustee shall otherwise determine, all dividends and other income received by the trustee shall be treated as income at the date of receipt, whether or not such dividends or other income shall have been earned wholly or partially in respect of a period prior to the date of receipt. So he gives them the power to pay taxes. He has the power to employ agents, and those agents could be a solicitor, an advocate, an attorney, a banker, an accountant, a stockbroker, or any other agent that he needs to help him in terms of executing his duties in the trust. He can purchase annuities, he can form companies, he can trade and carry on business, he can accept further properties, he has the power to insure, and he can insure against any loss or damage from any peril, any property, for the time being, that form part of the trust fund. He has the power to enter into contracts, and he can also incur obligations. So you could have a look at all the different provisions. In 46, the trustee has the power to employ investment advisors. He has the power to transfer property to any company. And what else he can do? And section 54, under expenses of the administration and management of the trust, it says he should keep accurate accounts of its trusteeship and may have them audited annually at the expense of the trust fund or the income thereof, as the trustee shall determine by a firm of chartered accountants selected by the trustee. So you can see all the provisions within the trust instrument the trust administrator will go through this document and diarize the powers of the trustees that were granted by the set law in the trust instrument. Any questions?
Nothing from me.
No.
Okay, all right. So 12 is on beneficiaries. So we've been talking about beneficiaries in a couple of the chapters. And we know that the beneficiaries have that right to sue. And that right to sue is based on that trustee's duty to account. And duty to account is based on his other duty to invest. So the trustee overall has a duty to always act in the best interest of the beneficiaries of a trust. He is to treat all of his beneficiaries fairly and impartially. And depends on the provision in the trust deed, he may also have to balance the interests of the income and capital. He has to make sure that the needs of the beneficiaries are met. So that means that he has to make sure that he effectively administers the trust. He cannot put his personal interests in conflict with his duties to the beneficiaries. That's what the case of Cowan versus Scargill was all about. Beneficiaries have a vested interest in the trust property are equitable owners. And equitable interests are preserved and protected by the trustees. Because when you have a vested interest, then you become an equitable owner. And being an equitable owner, then you are able, if the trust instrument does not provide a provision opposite to that, you can actually pledge those assets. So what are these beneficiaries' rights? Both in common law, which is case law, and in statute in the Bahamas, Section 83, beneficiaries have a right to information. And that right to information is not a blanket right. They have a right except for what is prohibited by law. So under common law, which is case law, trustees have a duty to give information to beneficiaries. And the first case for that duty was established in the case of O'Rourke versus Derbyshire. And in that case, the Lord Wenbury said, a beneficiary has a right of access to the documents which he desires to inspect upon what he has been called in the judgment, in this case, a proprietary right. And a beneficiary is entitled to see all trust documents because they are documents, because he is a beneficiary. Because in a sense, those documents are his own. But he's not entitled to see all documents belonging to the trust. Minutes of meeting, correspondence between trustees are not permitted to be seen by the beneficiary, especially minutes where the trustee has exercised his discretion and how he administers the trust. They are not to be seen by the beneficiaries. So by law, they don't form a part of the trust property for which the beneficiaries have an equitable interest and a proprietary right. Another reason why you would not let the beneficiaries see the deliberations that are made and of the trustee exercising his discretionary powers is because you can have a beneficiary challenging the exercise of that trustee's discretion. But he can see the title deeds, he can see the accounts, and he can see any other documents that relate to the trust. So in Reed London Dairy Settlement, which is the second case, it was decided that a beneficiary has to show the following in order to be entitled to inspect any document that's in the possession of the trustees. So first, it has to be documents in his possession, in the possession of the trustees. Then, the contain information about the trust, which the beneficiaries were entitled to know. And last, that beneficiary has to have a proprietary interest in the documents. So under the Trustee Act of the Bahamas, under Section 83, beneficiaries do have a right to information, but that right to information is under specified conditions. So a beneficiary can ask for production of receipts. They can be given to the trustee. They have a right to inspect trust accounts. They could demand information. They could ask explanation on it. But they can't demand for copies of trust account unless they're going to pay for it. So just like in common law, where a beneficiary cannot see deliberations, under the Trustee Act, Section 83, beneficiaries are not permitted to see the trustee's deliberation and how they distributed funds from either income or capital. So they can demand minutes of meeting. They can demand to see correspondence. They cannot see information that speaks about the trustee exercising his discretion. In the case of Schmidt versus Rosewood, which is the Privy Council case, the latest case that is being circulated, in that case, Mr. Schmidt had a discretionary interest under the settlement, and he sought disclosure in his capacity as a beneficiary, as well as in his capacity as the administrator of his father's estate. The trustee argued that Schmidt was not entitled to disclosure of the trust documents because he did not have a proprietary interest under the trust, that he was only a mere object of a power. The trustee argued that the father had been the settler under the trust, and that had been executed by Packard Limited as settlor. So Packard Limited was a nominee of Mr. Schmidt. The court held that the beneficiary's right to information was not only reliant upon the trustee's fiduciary duty to keep them informed regarding the provision and administration of the trust in general, but it was also upon the court's inherent jurisdiction to ensure that the trust is administered in accordance with the terms of the trust and always act on behalf of the beneficiaries to achieve the objective of the trust. So the discussion came around the classification of a document as what is a trust document. What is the beneficiary's interest? And what is their ownership rights to trust assets were not primary consideration in determining a beneficiary's right to information. So in the case of Schmidt, a document will be ordered to be disclosed if it would be conducive to the proper administration of the trust. It doesn't matter whether the document is classified as a trust document. It's whether or not the document is conducive to the proper administration of the trust. So requests from beneficiaries must be reviewed on a case-by-case basis. And the trustee has to be guided by the purpose for the beneficiary's request and the interest of the beneficiary. So what does Schmidt's case decide? It decided that a trustee has to take into consideration the following information when making a decision to disclose trust information to a beneficiary. One, he has to look at the nature of the request being made by the beneficiary, the reasons why the beneficiary wants to make the request. What is the information that the beneficiary wants? And then look at the sensitive nature of the information that's being requested. Now, the trustee can decide that he's not going to give the beneficiary any information, especially if that information is privileged or it's confidential, or the interest in the trust is a remote one or contingent one. So that means that he's not a vested beneficiary. He is one who may be a beneficiary in the event there is a matter that is triggered by a requirement in the trust instrument. Or the information may be prejudicial or adverse to the trust. Or the disclosure may just be too costly to the trust. So yes, beneficiaries have that sole and exclusive right to sue in relation to the breach of trust or any other action related to the administration of the trust, because the trustee has duties and obligations to the beneficiaries. In the Act under Section 24, trustees are permitted to insure themselves from the trust fund for legal actions that may be brought by the beneficiaries, but they cannot use that protection when there is a breach of trust. So beneficiaries, again, have that right to terminate a trust through the use of the rule in Sanders versus Vautier. And like I said before, they can, all being sui juris, properly ascertain and complete as a group, and they are beneficially entitled, making sure that there are no unborn or unascertained or unascertainable beneficiaries. They can bring the trust to an end. But that right of beneficiaries to use that rule can be restricted, and it depends on circumstances. A said law may exclude this rule by placing an express clause within the trust that the beneficiaries shall not be able to bring the trust to an end collectively and request the legal title to the trust property. So the trustee has to control the administration and management of the trust. Beneficiaries, while they may have an equitable interest in trust property, are not entitled to dictate to the trustees how they should exercise their powers and discretion that's contained in the trust instrument. The common law principle allows the trust to run smoothly, free of any interference from the beneficiaries, especially those who are looking to advance their own interests at the expense of other beneficiaries, or trying to get some inappropriate behavior to gain more knowledge to see exactly how the trustees deliberated when they made their decisions to either pay the life tenants or the remainder man. So the trustee has to be very mindful of their legal and their fiduciary duties to the trust and to the beneficiaries. Any questions?
No questions.
Okay. And the last one is Unit 13, breach of trust. Any questions there?
I haven't gone over it as yet.
Okay. So I think we've talked about breach a lot. So we know that that trustee has his duty of care and skill in carrying out his responsibility. He has to act honestly and in good faith. He has to execute his duties, making sure that he preserve and he protect the assets of the trust. And as long as he performs his duties in accordance with the terms of the trust instrument and within the laws of the trust, he can avoid being sued for breach of trust. A beneficiary who is an equitable owner, he can bring a personal claim against the trustees for breach. And that breach could be of his fiduciary duty, or it could be of any other duty that he owes to beneficiaries. Now, in order for a beneficiary to say they're bringing an action for breach of trust, there has to be a breach of some duty. So remember I said to you earlier when we started at the beginning that you must know the duties of a trustee. Because if a beneficiary wants to sue for breach of trust, you have to make sure that the action that he's suing for falls within one of the duties. So damages are recoverable for breach of trust in equity. And they're the same as damages recoverable for negligence or for breach of contract under common law. So while compensation for breach of trust is an equitable claim, same as a claim in common law where damages are awarded, beneficiaries have to prove that there was some loss that occurred due to the breach of trust. So the measure of liability for a breach is the loss, and that loss could be direct loss or indirect loss caused to the trust, and is normally compensatory but not punitive. So you don't penalize the trustee. The trustee has to compensate the trust. So the onus is on the claimant, who is the beneficiary, to establish a link between the actions of the trustee and the loss that was suffered. So when you talk about breach of trust, there are different levels of breaches. You have serious misconduct and you have innocent breaches. So you can have a wrongful distribution of income or capital. You can have an incorrect exercise of a trustee's discretion. You can have a trustee not distributing income or capital, which was actually stipulated in the trust instrument. He could have not selected or supervised his agents properly. That can cause a beneficiary to sue for breach of trust. You can have misappropriation of trust funds for a trustee's personal expenses and for his own benefit. You can have failure to obtain the requisite or the relevant consent as stipulated in the trust instrument. He could have purchased trust property without authorization, either from the trust or from the beneficiary or from the protector. He could be unlawfully profiting from the trust. He could be investing trust funds in unauthorized or unsuitable investment. Or he could be one of those trustees who's never available to give the beneficiaries information on the accounting of the trust. So any of those grounds, a beneficiary can sue for breach of trust. Now, what are the remedies that are available to that beneficiary? He can go to the court for an injunction, which means to stop the trustee from doing what he's doing. Or he can go to the court and he say, I'm going to bring an action against the trustee for the loss that has been suffered. And remember, for the loss that has been suffered, he has to be able to prove a causal link between the action of the trustee and the actual loss. He can also have a proprietary remedy to recover the trust property. So that means that he can actually have a request made to the court to make sure that that trust property that the trustee sold to another person is returned to the trust. And then he can bring an action against those who have received the trust property. So that means the person who the trustee sold the property to. So in your notes, you'll see where I gave you some cases, an example of each one. And you can find the summary for those online. So when there is a breach of trust, all the trustees are liable because it is joint and several. Anyone can be held liable for the loss that's caused by the breach. But an individual trustee may be liable for a greater contribution for the loss caused by a breach of trust. So to make sure that the trustees pay their fair share of the loss, a contribution on indemnity may be claimed in certain circumstances by any of the other trustees. A new trustee is not liable for breaches of trust committed before he took up an appointment. Now, to rely on that, he had to have carried out his duty to familiarize himself with the trust. He has to examine the trust documents, look at the books of trust, and if he sees that there is a possibility that there has a breach of trust, which means that the trustee did not carry out his duties, then he needs to address that. A retiring trustee remains liable for any breaches committed by him during his tenure in office. He's not liable for any breaches that are done by his successors unless he had knowledge of that breach and that it was likely to occur. Again, under Section 24, trustees have that power to insure themselves, and they can pay the insurance premiums from the trust fund. And you saw that just now in that purpose trust deed. So they can insure themselves and pay for the insurance from the trust fund for liability in the administration of the trust. But that insurance does not cover breach of trust. The Trustee Act also gives the trustee certain protection against liability for loss suffered by the trust due to an agent when they're carrying out their actions. Again, the conditions to that is it must be done honestly, reasonably, and in good faith. So a trustee who is liable for breach of trust could seek relief from liability if the terms of the trust allow him to do so. Or he can be indemnified by the beneficiaries. Or if there'd been some act on the part of the beneficiaries and they participated in the breach. Or they could waive their rights to sue for breach of trust due to some collusion that they had with the trustee. All of those are conditions that they have to look at. So under the Trustee Act, what the Bahamas has done over the years from 2011 to 9 or 2009 to now is we have looked at beneficiaries bringing matters before the court for breach of trust. And what we have done is use the Arbitration Act as a means, one, to bring matters relating to breach of trust, where matters can be settled, disputes can be settled in a more efficient manner. So they use alternative dispute resolution to arbitrate the matters. Is less costly. It doesn't take a lot of time. And those decisions are contractually and legally binding on the parties. So in most of the new trusts, there is a provision for arbitration. Any questions? Comments?
No questions.
Okay.
Comment on my end. I feel as though this one on beneficiaries is the most easiest. Is the most easiest chapters.
Which ones?
This breaches and beneficiaries.
Yes, it is. It is.
Everything else is very foreign.
Well, we have review on Thursday. And so for the chapters you haven't read, read it. On Thursday, when we meet next week, I will tell you the areas that is on the exam. Based on those areas, if you have questions in those areas, you can ask at that time.
Perfect. I love that approach.
Yes, me too.
And as a surprise, just don't surprise me and write foolishness. But I will tell you
Oh,
what's coming on the exam. I will give you the areas.
Okay.
But ask you, depends on how the question is worded. I may just take, let's say I may say, there's a question on breach of trust where a beneficiary brought a matter. In what ways can a trustee reduce his liability in that situation? Y'all gone silent. We just read that 2 minutes ago.
Oh, that was a question. Sorry, I thought you was like.
Yeah, I thought the same thing.
It's a question. It won't even be as easy as that.
okay.
Okay, repeat the question again. Sorry, I thought you was just like giving examples of how you would word stuff on the
Exactly.
exam.
Yes. Yeah, that's what I was telling
No,
you.
I didn't know. That's why I asked you to repeat it. I didn't realize you wanted us to respond.
So I'm saying beneficiary is suing for breach of trust. And in suing for breach of trust, he has done some certain misconduct. The question could ask you, after I've given you the scenario of what happened, it can ask you, how can the trustee reduce his liability?
An injunction, no?
No, that's not going to reduce his liability. How would that would reduce his liability?
A way it could reduce his liability is in the event that the beneficiary had some colluding with it.
There you go. You see how easy that was?
Okay.
But it's more than one. In that paragraph, there's 3 or 4.
Right.
Yes. So I could give you a scenario where something happened, the trustee did blah, blah, blah with the beneficiary, whatever it is. Remember, to bring an action for breach of trust, you have to know the duties. A breach of trust is connected to a duty.
Okay. Oh, sorry.
Okay? So I don't expect you to remember that is section 5 dealing with investment, section 4. But you should be able to say under the Trustee Act, it states that a trustee is required to do this, do that. The same sections that you see in the manual. I don't expect you to know the numbers verbatim, but you should know what the act contains and what's relevant to the section. Now, the sections that you need to know for relevancy will be after Thursday, when I tell you the questions that are coming on the exam.
Okay.
And if there's any particular case that I think you need to know that's in your manual, I will tell you that also.
Ms. Archer, just a question. Is the exam going to consist of like essay questions, multiple choice, filling the blanks?
That's a joke?
Structured. I asked the same thing already on the structured. And I was told they're looking for 2-3 sentences because these points,
Yeah.
these questions, they were points. So you better come with your A game.
Yeah.
When you don't forget that this area, notice when I tell you, okay, a trustee has done this. What do I say? The court say, you need to take these things into consideration. So multiple choice would not demonstrate to me that you understand. You just pick it. I need you to understand,
Okay, yes.
because we're built on this. This is a building block. You do this, then you do part two, then you move into step. Multiple choice is not going to help you for the foundation.
Mhm. Okay,
Okay.
You'll find out later when you move into the other parts is you're going to just get weaker and weaker. Certain things should be solidified in your brain.
right.
So I need, and if you don't pass, then you do it again.
Oh, boy.
And how soon you could do it again?
Probably next week.
Okay. All right then.
So don't aim for that, aim to pass.
Yeah, no, of course not. Of course not. But I just want to know where.
But now, why I say that is because when if you need to take it again, I'm not there to tell you what's on the exam. I'm just writing it and dropping it off.
A different exam?
Yes, a brand new exam.
Oh, boy.
Wow.
So when I speak next week, listen.
So we don't have classes Thursday?
No, I think the schedule says August the 3rd.
Oh, okay.
Oh, okay.
Double check your thing on my one says August the 3rd.
Yeah, mine says that as well.
Yeah.
Okay.
Right.
Okay.
So that gives you sufficient time for the chapters you haven't read to read again. The ones you're not too sure of, read it again. And Thursday, when I tell you these are the areas, you'll know exactly which ones you want to focus on, you feel more comfortable on. Don't
Mhm.
do what a lot of students do. We go through all of that. They decide which questions they're going to do in the exam. Then they get in the exam. They read it again. They don't like it anymore. They pick a different question, which they did not study. And so then they write me 3 lines.
Oh,
Oh, so you select what questions you want to answer? Like,
On Thursday, I will give you the choice. You can either select or I could tell you.
okay.
okay.
Some students prefer to have 5 questions. That's it. Some students say they prefer to pick through.
Okay. I follow what you're saying.
Mhm.
Or third way I can do it is I and then you pick a few questions.
Sorry, I didn't get that. Can you repeat that? The third way.
One is I can put like 2 mandatory questions and then you choose out of the rest.
Okay, okay.
Mhm.
So I can do it 3 different ways. And we could decide that on Thursday.
Okay.
Whichever one the class feels more comfortable with.
Okay.
But it's not a guessing, it's not a guessing exam.
Mhm.
Yes, ma'am.
Okay?
No multiple
So for the
choice.
chat, read it and read it again.
Yes, ma'am.
Good luck.
Miss
Thank you.
Archer, just a question. Is
Go ahead.
there I've heard of something called lifting the veil.
Piercing, lifting the veil or piercing the corporate veil.
Okay.
That's in part 2.
Oh, okay, part 2. Okay, okay.
You want to know what that is?
Yeah, if you could explain it for me.
So a company is a separate legal entity,
Uh-huh.
person of itself. The reason why a person would incorporate a company is for legal protection. But the court can go behind the company and sue the owners of that company if they feel that owner was seeking to defraud the person who has brought the action. That's what it's called, piercing the corporate veil or lifting the veil, where the court goes behind the company and goes directly to the owners of that company. So some people do that when they seek to defraud. So let's say they know they owe you, and instead of you being able to come directly to them for it, they'll form a company and put the asset within the company. And then the person decides to sue. So in order to get to the asset, they go to the company, but the company is a separate legal entity. It's not the same as the person who had the property before. So what the court will say was that you sought to defraud. And so I am going to go behind the company to you, the beneficial owner. That's piercing the corporate veil.
Thank you.
We have that in the next class, and we have cases for that.
Okay.
Many. And that section, that part 2, when we look at companies, we're going to look at companies because in a trust structure, as it said in the introduction, people would create trusts for estate planning, wealth management. And so the structure of the trust is at the very top. Underneath, there can be operating companies, there can be holding companies. So you have to learn a little bit about company law. Because you need to know what's the law behind a company. What can a company do and not do? Who is the director? What's the role of the director? What's the role of the secretary? How is it structured? Capital is required. All those kind of things. But that's in the next part. All right?
Yes, ma'am.
Okay. So I don't know y'all next week. It's just everybody.
Yes, yes, ma'am.
Okay.
Never,
So I
I
have
never,
a quick question before we end, right? I know earlier you were saying something about yesterday class, but I didn't catch the rest.
no, I was saying yesterday class was recorded. So you can get the
Oh.
recording.
Okay.
Yeah. I did from the introduction up to unit 7.
Okay.
So like I say, next week when I come, I don't know y'all. I never spoke to y'all. So do not refer to this week.
Yes, ma'am.
Yeah.
Because I can get someone saying, you, and Theodore know just what I mean. You know,
Yeah,
I
I know.
okay, some questions at all.
Uh-huh.
Yes.
So none of that.
Yes, ma'am.
Or when I come, I'm just going to talk about any questions, any particular chapter. No one have nothing to say as usual. Let me tell you what's coming on the exam.
Okay.
All right. Have a good evening.
Thank
too.
you.
Thank
All right,
you.
thank you. Good evening.
Okay.
And
Good
there's-
evening.
okay. Theodore, if you don't get the link, just ask Ms. Dean.
Okay.
Yeah, she'll send it
All
to
right.
you. Okay.
Thank you.
All right.
Thank you. Okay.
All right. Have a good evening.
Good evening. You too. Good night.
Good night.